second. Good.
Put on slideshow, man.
I will in a second. All right, so I'm going to start it now, okay? I'm going to show that, and I'm going to go on. Start broadcast. Okay, so now that's there. Questions, leave that open. All right, so we're good.
Good morning, everyone. My name is Robin Graham. I'm Vice President, Strategic Business Development and Associate Portfolio Manager with Hahn Investment Stewards. Joining me this morning is Christian Urbanski, Vice President, Business Development and Associate Portfolio Manager with Hahn Investments as well. Christian's specialty is working with advisors, servicing and building our advisor relationships. And we're happy to have you join us this morning. We're going to both presenting to you on how to deliver premium investment solutions to high net worth clients. I'm going to start out by making a few comments about the firm and what we do and why we think we're a particularly good fit for both high net worth and institutional clients. And then Christian will talk about how to partner with Hahn as an advisor to add value to your practice. So here's an agenda. I'm going to talk a little bit about Hahn philosophy, who we are and what we do. We did notice in the registrations this morning that a number of you were new, so we thought we'd better start with a few basics. Then we'll get into our investment process in more detail. We'll talk about the Hahn portfolios and how they're constructed in a little bit of detail. And then I'll turn you over to Christian to talk about how to partner with Hahn. On this slide, page number 3, you can see the Hahn Investment Strategy Committee. Essentially, the firm was founded with the philosophy to do something quite different from what most investment management firms out there are doing today. Our founder, Wilfred Hahn, who's co-CIO of the firm, started Hahn in 2001 after heading the Global Investment Group at the Royal Bank of Canada for over a decade in the 90s. During that time, he led a very large team, but began to realize more and more that asset allocation is by far the most important investment decision in the portfolio, and he wanted to start a firm where the firm was focusing primarily on active asset allocation. Around the same time, we also began to experience an explosion in the variety and type of exchange-traded funds available, and starting in 2003, we then began to build global macro portfolios entirely with exchange-traded funds. The other two key members of our investment strategy committee are Mark Arthur, who's CEO and director of Hahn. Mark and Wilf actually worked together for many years at the Royal Bank. And Tyler Morty, who is our director of research and co-CIO, is also a key member of the investment strategy committee. The strategy committee meets quarterly, makes tactical asset allocation decisions at that time. They work very closely together, and they are supported by 2 additional analysts. So still on the subject of philosophy, I'll tell you a little bit about how investing has changed, particularly since the global investment crisis, which was a very upsetting event for everyone, for investors, for advisors. And the CFA Institute did a research study following the financial crisis. So this little book that you see on this slide is actually available on the Hahn website in PDF format, or you can buy it from the CFA Institute for $10 or $15. But it's a very good summary of how attitudes and philosophies changed globally. They did a research study of consultants, institutions, pension funds, foundations, and high net worth investors throughout the world and advisors, and asked them how they felt investing had changed or needed to change as a result of the crisis. And in the bullet point 3, you can see the key findings that came out of that research study. A general acceptance that asset allocation is indeed the most important decision in portfolio management. And after years of focusing on private equity and alternative investments and stock picking, this was a new realization about what is really important and what needs to be focused on. Also, that a top-down approach is needed. So rather than focusing on selecting individual securities, let's talk about what's going on in the world. Markets are interconnected. A top-down approach that looks at macroeconomic forces is by far the most important decision. That asset mix decision needs to be dynamic, so it is no longer sufficient just to build a static asset mix portfolio and rebalance it every 1 or 2 years. we need to proactively and dynamically manage that asset mix. The investors surveyed were looking for greater diversification because many people who thought they had diversification in the financial crisis found out that their portfolio was indeed not diversified to the extent they thought they were. So the need today is to look for further afield, for greater diversification globally, more asset classes, more regions of the world. Not surprisingly, there's a greater demand today as well for transparency. Investors want to know what's in their portfolio. Some of the stuff that people were invested in the financial crisis was not that liquid, not that transparent, and there were a few surprises and shocks for investors at that time. Clients today want transparency, which is why the exchange-traded fund, which is completely transparent, is growing in popularity among investors. And finally, the final thing that came out of the research study was that there is a growing demand today for managers that actually have multi-asset experience, that is, experience building multi-asset class portfolios. Most managers traditionally are specialists in one area. They're an equity manager or a bond manager or a small cap manager. But today, people are looking for managers that have multi-asset class experience, and Hahn is an example exactly of a firm that does exactly that. So we'll get into process now at Hahn. We build multi-asset class portfolios, and we start with major asset class decisions by, if you boil it down to the simplest level, we're really building portfolios out of cash, bonds, equities, and alternative investment classes that we call opportunity asset classes. Within that, there are multiple decisions to be made within each asset class. Under cash, for example, there are a number of decisions to be made there. There are a number of decisions to be made for fixed income, equities, and opportunity asset classes. So by the time we make all these multi-levels of decisions in the portfolio, you have an extremely diversified, sophisticated portfolio with diversification across asset classes and throughout the world. This is a chart of the global equity market going into and out of the global financial crisis. It's really just the Morgan Stanley World Index and shows you the volatility that was experienced by clients at that time. But Hahn has a rigorous investment process that identifies risk proactively before it happens and manages it through the volatility to position you for both, to protect you from downside volatility going into risky markets and also to position you for the opportunity that is available when you come out of markets like that. So if you look at the minutes from our investment committee meeting back in those days, June 2007, Hahn was already taking risk off the table at that time. And here is a quote from our investment committee meeting at that time that while people were rushing to, at that point, to still take on risk and we were in a bull market and people thought it would last forever, the Hahn Investment Committee had already identified that things were becoming expensive, that there was risk on the table, and for us that it was time to reduce our exposure to some of the riskier asset classes. Conversely, in the March lows of 2009, our institutional investment process encouraged us and helped us to make decisions to reinvest in risk at that time. It was not an easy decision to make, but our disciplined process helped us to make those decisions on a methodical basis. On this slide, you can see the before, and on the next slide, after the financial crisis, how the Hahn portfolios were positioned at the very simplest level. Obviously, as I mentioned, we were taking risk off the table, and going into the crisis, we started to raise our cash level, increase our fixed income exposure, and reduce our exposure to equities. In March 2009, we changed our asset allocation exposure. We were still overweight in our opportunity asset class. Cash we reduced, bonds we reduced, and took risk back on by increasing our equity exposure at that time. So we do make active asset allocation decisions at Hahn. In the next slide, you can see historically, over the last 10 years, the magnitude and frequency of those asset allocation decisions. They're not wide swings, obviously, but they are active. And active asset allocation is where we add our value. I'm going to talk next, excuse me, a little bit about the Hahn portfolio. Of course, when you're dealing with clients, any kind of client, be it an institutional client or a high net worth client, It always starts with an assessment of that client's investment objectives, their risk tolerance, and of course they need an investment policy that captures the investment program that you're going to be putting them into. We have documents at HAN which detail the investment policy for every one of the strategies that we run for clients, and we fit, using a risk tolerance questionnaire, the appropriate portfolio to each client based on their risk tolerance. Here's an example of one of our strategies. We run 11 different ETF portfolio strategies at HAN in the Canadian domiciled market. This is a snapshot of the portfolio structure for one of them. So you can see that every HAN portfolio has a defined investment policy. So although we're making active asset allocation decisions, it is within the disciplined confines of a structured investment policy statement for that strategy. So what you're looking at here are the various asset classes that would be represented in the HAN portfolio. It shows also the latitude that we are permitted to use within that investment policy. So for example, starting on the left, our opportunity asset class, which is a basket of diversified, non-correlated assets. We have the latitude to have 0 to 20 or 25% exposure in that particular asset class. The other bars to the right show the traditional asset classes: cash, bonds, stocks. We diversify more than most managers throughout the world, splitting those asset classes into domestic, U.S., and international exposures. The black bar in each bar shows the benchmark. We do measure ourselves against a composite benchmark. It's a benchmark that is a diversified basket of asset classes similar to the portfolio. It does not change. The latitude you see is the minimum and maximum exposure we can have in any asset class, and the little brown diamond is our current exposure over or underweight as of last quarter end. So we do make active decisions within the investment policy. The policy protects your client and determines the overall risk that the client will be exposed to. On this next slide, we're on page 13. You can see that there are in fact 11 different ETF strategies at HAN. You will help and work with us to determine the right portfolio for your client. Why are ETFs used? HAN is primarily a global macroeconomic active asset allocator. We're an ETF strategist because we believe that ETFs are the single best vehicle to implement our global macro strategy today. ETFs have really revolutionized the investment management industry. They've changed the investment game forever. And they've done it in three specific ways shown here on this slide. What have ETFs done? Well, they've opened up the world to investments that you and your investors just previously would have found very difficult to access. Through the exchange-traded fund vehicle, you can get global diversification far beyond what most portfolios previously had. You can invest anywhere in the world today, whether it be Indian financial services, Asian markets, Asian fixed income. It's all there, and we are able, therefore, to get greater diversification than we had previously. In a second way, ETFs have changed investing. They've opened up asset classes that previously had limited liquidity. Examples of this would be commodities, currencies, real assets, real estate. Many of these asset classes would have been ignored or overlooked by portfolio managers previously because they weren't liquid enough to manage actively. They were hard to access, they were expensive to access, and so they were just not included in the portfolio. Now with ETFs, virtually every asset class in the world has liquidity and can be accessed immediately through your local stock exchange. And the third important way that ETFs have changed investing is the facilitation of active strategies. So as an active tactical ETF strategist, HAN wants to use underlying investment vehicles that allow us to implement our active strategies easily and cost effectively. The ETF does exactly that for us. We can make changes in our portfolio. We don't have to sell hundreds of stocks. We simply go to the market, and with one trade in a single ETF, we can adjust the asset mix of our portfolio accordingly. We show here a quote by our founder and co-CEO, Wilfred Hahn, who was quoted as saying that we can today build portfolios with $100,000 that are of superior quality than what he was able to do for very, very large pension funds 10 or 20 years ago. It would have taken $10 or $20 million to build a portfolio 20 years ago that we can today with an ETF with as little as $100,000. It's important to select the ETFs carefully. It is part of what we do at Hahn, conduct the due diligence on the ETFs that go into our portfolio. It's a rapidly growing category and over 4,000 listings available in the world today. It's our job to filter that down to an actionable universe of approximately 350 ETFs, out of which a portfolio will be comprised that is normally consists of 18 to 22. With that, I'd like to turn you over to my colleague Christian Urbanski, who will tell you more about how you as advisors can partner with Hahn to bring these services to your clients.
Thank you, Robin. Hello, everyone. Once again, thank you for joining us today. We do appreciate your time. And just one housekeeping comment. If you do have any questions, there is a box on your screen that you can enter your questions. So at any time, please feel free to ask a question. We also will have a session at the end for questions. So let's begin. The first thing that I'm going to talk about is some of the challenges that we're facing in our industry today. We know that regulation is becoming more stringent. Compliance issues, fee disclosure. In fact, recently a new fund fact sheet was created, which is called a point of sale document, which essentially outlines all the key facts of the mutual fund, but it also discusses details about fees, in fact very specific. So it does outline the MER as well as the trading expense ratio for a total expense ratio. Just one quick example, I'm not going to mention mutual fund, but the MER is listed as 2.98. The trading costs are 60 beeps, so you're looking for a total cost to a client at 3.6% or close to 3.6%. Another initiative that is taking place is the actual commission disclosure on client statements, and we're going to discuss that in some detail with a case study, the next slide, but also performance. The media has deemed the last 10 years, the last decade. Obviously, we had two major market corrections over the last 10 years. Even clients in fairly balanced portfolios did not make a lot of money. Another problem right now, and Robin alluded to it, there's over 4,000 ETFs at the moment available, not counting individual securities and bonds. In terms of mutual funds, if you do a search on GlobeFund, a universe search, there's going to be over 16,000 different pool products available. And obviously there's different share classes, but needless to say, it is a lot of products that we as professionals have to select for our clients. And let's be realistic. How much time do we have in a day with all our client meetings, client reviews, to actually seek out all these different products and follow them? Another important aspect is competition. We all know that your business essentially involves two different aspects. One is financial planning, financial advice, and the other is business development. With the internet, with different systems, technology, software, I think financial planning is becoming a little easier for us to do, but business development is still difficult. With social media, you know, the Twitters, the LinkedIn, and so forth, the Facebooks of the world, it was tough to develop business 20 years ago, and it's tough to develop business right now as well. And I'm going to show you how Hahn can kind of help you with all these different issues that are happening. So let's move on. We're going to start with a very simple case study, and I call this the $1 million client. So let's assume that I'm a client. I was with one advisor over the last 10 years. My portfolio MER is about 2.2%. Obviously, it could be higher, it could be lower. Essentially, let's assume that the initiatives brought forward by the CSA come to reality, and my client, I'm a client, and I will get a statement outlining that I paid $10,000 to my dealer and advisor over the last 10 years, which essentially is $100,000. In fact, I'll be paying $12,000 per year to the manufacturer, and over the last 10 years, $120,000. So total fees paid is $220,000 over the last 10 years. Now, we're in a business. We understand how fees work, and let's be realistic. It's all relative. When the markets are hot, nobody really talks about the fees, but when the markets are struggling, and especially the last 10 years, the media jumped on the fee bandwagon big time, and everybody's talking about low fees. Don't get me wrong. Obviously, the fees matter. And what's more important, optically, it looks a lot different when a client will actually see a dollar amount versus an expense ratio in a percentage amount. So what's going to happen? As a client, I know that over the last 10 years, I paid $220,000 in fees on my $1 million portfolio. Is there a chance that I might be looking for a second opinion? If I haven't made money over the last 10 years, chances are good I'm going to talk to my family member, brother, sister, my neighbor, and they're going to suggest to visit their advisor for a second opinion. Now, I'm going to see the second advisor. The advisor is going to say to me, well, you know, if you were my client, I would actually put you in this product, that product, and over the last 10 years, you would have made money. Now, I'm pretty rational. I would say should have, could have, would have. I like my advisor. I understand that the markets have been difficult. I'm going to stay with my advisor. So that being said, we feel that this is an opportunity to you as a financial advisor when you get a new prospect looking for a second opinion. And an opportunity exists with this slide. I'm going to take this slide and explain it further, but essentially when a prospect comes in, you're not going to discuss only mutual fund, but you're going to discuss a different way, a new way of doing business, and that's discretionary portfolio management. As Robin mentioned, you need a lot of money as a pension and institutional client to get into the discretionary portfolio management space. And in fact, in many cases, it was millions of dollars that was needed. As a retail client, you know, when we get our first bank account, then we kind of move into a GIC account, maybe a kind of saving bond. Then once we get more sophisticated, older, we transition to mutual funds, maybe wrap programs, and in some cases, individual securities and individual bonds. But what if you had this opportunity and you say to a prospect, well, for a low entry point of only $100,000, I can get you into the same space as pensions and institutional clients, the same space as the Ontario Teacher Pensions Plan and others like it. Now, I think this is going to create interest in the client. It'll give you another opportunity to discuss this in more detail and obviously position your services and so forth. So moving on. What's one of the key benefits of dealing with a discretionary portfolio manager? One of the key benefits is separately managed accounts. Now, if you actually look at a pool product, a mutual fund, you have client A, client B, investing $100,000 each. The money's combined goes into a pool, and a portfolio manager manages that pool. What happens in client's A account, for example, money being taken out for whatever reason, has an effect on client B. Essentially, maybe the MER being higher because there's less assets under management, also distributions and so forth. In a separately managed account, just like the name suggests, your account is separate from anybody else. The other person taking out money has no influence on your account whatsoever. So some of the key benefits include individual cost base. Another pretty major benefit is tax harvesting. As you know, most mutual funds are unable to claim capital losses. We have the ability to take advantage of capital losses, which could be potentially very, very beneficial to the client. Another huge benefit is the management fee. A client can actually deduct the management fee from their income, and that's the portfolio management fee. In our case, it's 0.8%, and it's tiered down based on the amount invested. Now, another option that we do offer, if a client has two accounts with us, one non-registered, one registered, we give the client the ability to actually deduct the fee from the non-registered account for both accounts, essentially taking advantage of deductibility for the full fee paid. We offer full portfolio and fee transparency. In many cases, as a mutual fund, you will see the top 10, maybe top 20 on a monthly basis, maybe on a quarterly basis. Once a year, when the mutual fund issues a financial statement, you will see all the holdings. In our portfolios, the client has 24/7 access as the financial advisor, and they see all the holdings. Another important aspect is in a mutual fund, the client actually owns the part of or share of the pool. In our case, they actually have they own the individual securities. Obviously, individual reporting. In our case, we deal with two custodians. One is being TD Waterhouse Institution Services. The other is Fidelity Canada Clearing. The client has the option of selecting a custodian that they choose. They will get a statement from the custodian on a monthly basis and a statement from HON as well on a quarterly basis. And as I mentioned before, customized fee is possible. Our fee is tiered down, and the advisor has the option of selecting the fee as well. So let's move on. So how do we actually help your business? We know that many financial advisors, many companies try to develop a specific niche, either based on certain segments of the market, maybe demographics, spend a lot of hours, a lot of money to do so. So everybody's kind of looking to separate themselves from everybody else, from the competition. While we're giving you a very easy way to differentiate yourself from your peers and colleagues. Once again, once a prospect comes in, you can look at a portfolio. You know they're all mutual funds, for example. You have a very good hook, essentially, to start a conversation. Once again, pension style of investing for individual retail clients. Attract more segment 1 clients. This is, I think it's very important. Now, once again, because this is a different service, a lot of more sophisticated, high net worth clients like this type of service, and now it gives you an ability to offer something like this to your clients. More time to concentrate on other income producing ventures. This is really important. We take care of all the admin work. We obviously do the portfolio management. You don't have to do the research. It's interesting because Wilfred Hahn made a comment, and he said, we're not gurus. We're not investment gurus. We're grunts. It takes hours a day to do all the research in order to have a risk, a good portfolio and good risk management. So it is a lot of research that we have to take into consideration. Do you have the time to do this? With us, let us take care of all the research. Let us take care of all the portfolio management. You concentrate on your client meetings and concentrate on other income-producing ventures as well. Once again, as Robin mentioned earlier, when a client deals with us, they complete one of our risk questionnaires. By doing that, essentially, you're offloading their compliance to HON. And we're saying build a business system as well. Now, I do a lot of traveling and a lot of meetings with advisors, and advisors always say to me, how do I add value in dealing with HON? How do I add value in dealing with a portfolio manager? My simple answer is this. Dealing with us is no different than selecting a mutual fund. You still have to do the due diligence on the portfolio manager. It's the exact same thing. But beyond that, I believe the added value comes from the actual financial planning, retirement planning, obviously if your clients have kids, educational planning, offering other products like insurance, estate planning, succession planning. We all know that every client's different. Each client has individual needs, and product selection is only a small portion of the whole comprehensive picture for a client. Now, moving on, I want to share with you an interesting chart here, and it's interesting because it talks about what's the actual contributor to the wealth effect of a client. So what actually contributes to the greatest effect to clients' wealth? And what's interesting is that tax efficiency is number one at 28%. Time invested is number two at 26%. Managing emotions, I think, is one of the key components that a financial advisor in terms of adding value does. Asset mix, this is where it's a different color in terms of gold because this is where HAN comes in. Portfolio cost is actually surprising. It's only 7%, and security selection is only 2%. So going back to how do you add value? Well, you can create a very tax-efficient portfolio. Obviously, you can educate your clients about different investments, about different markets, and really manage their emotions in difficult periods. Asset mix, you're selecting a portfolio manager that does the asset allocation, like HAN, so obviously you're adding value. And as well, selecting products that are low cost to the client. So in terms of, do you add value? Yes, there's different ways that you can add value for your client. Now, moving on. So what are some of the key client benefits? One is the SMA structure that I already discussed, tax efficiency, individual cost base, and so forth. One of the key, and we always talk about the alphas, the betas, and the portfolio construction. When a client comes in and sees you, the fundamental truth of investing is that they want to actually make money. That's realistic. So when they come to you, bring you $100,000. When they come for a client review, they want to see 110, 105, whatever the case may be. They want to see more money. So with HAN, you're getting consistent benchmark beating performance. I'm not sure if everyone's familiar with the SPIVA report. It's a Standard & Poor's index versus active report. This is essentially 3 different reports, one for Canada, one for US, and one for international. And it compares all the active managers versus the benchmark, their specific benchmark. And in fact, over the last 5 years, and this is from the last report, only 2.9% beat the benchmark over the last 5 years. Now, that's pretty dismal. So if a company has 100 different mutual funds, on average, about 3 mutual funds consistently beat the benchmark over the last 5 years. We have 9 portfolios launched in June 2003, so almost 10 years, and 2 portfolios launched in June 2008, almost 5 years. 11 out of 11 were beating the benchmark, and we're making money for the client. So I think those are pretty impressive results. And not only beating the benchmark, but we're doing it very consistently with low standard deviation. And just to that point, our standard deviation for our portfolios ranges from about 4.6% to about 9% on the high end. Another key important aspect is access to some of the world-leading ETFs. I know there's a lot of exposure in the media about the benefits of the ETFs. Now you have a new story to share with your clients, and you have access to these as well. Ongoing portfolio review, comprehensive portfolio reporting, full transparency, and lastly, it's not on the slide, but pension-style investing for your clients. And a different story. A lot of people are kind of discouraged in terms of mutual funds. And don't get me wrong, we're not saying that all mutual funds are bad. There's definitely some great managers, but the reality is a lot of people haven't made money over the last 10 years, and they're looking for a new story. So moving on, how do you engage HAN? Well, there's 2 ways. If you're working for a dealer, we do have relationships with most dealers in Canada. Essentially, when you buy our product or one of our portfolios, the commissions is flown through a dealer, just like a mutual fund or any other product, and you get paid based on your credit. If you are independent, possibly dealing with insurance, we can sign a referral agreement directly with us, and then everything is flown to you. Now, it's very simple to actually position this with a client. And in fact, I have one advisor that calls every single client, specifically the clients that have under 100,000, and uses us as a tool to help him consolidate client assets. And in fact, he calls the clients and says, I have this new company that I deal with, their discretionary portfolio management, come see me, we'll discuss it. The only problem is the minimum is $100,000. You have some money somewhere else that we can look at and take advantage of this. So there's different benefits of discussing HON for your clients. Add your fee to our wholesale rate. So once again, our fee starts at 0.8%. You have an option of adding whatever you want. If you want to give your client a discount, you can. If you want to charge 1% the standard, you can. And even if you want to charge 1.25, you have that option as long as you can justify it to your clients. Now, as I mentioned earlier, we do the bulk of the admin work for you. There's a document that we call a discovery document. Essentially, that's filled out. You send that to HON admin. HON admin will prepare all the custody documents, send them back to you for client signature. And once again, our company's full transparency. Everything is available 24/7. Your client statements. We will help you with anything that you would like in terms of creating a specific marketing niche or a specific marketing story for your clients. We can help you with newsletters that you want to do for your clients. Any type of business development projects that you want to do, we can help you with. So moving on, let's take a quick look at one of the funds that we have, and this is the international balance. So the international balance is in the blue. And as you can see, the standard deviation on it is only 6.69. The benchmark, which is in gold, the standard deviation is 6.01, so slightly lower, but the performance, as you can see, for the benchmark is 4.37, 7.26% for us. What's interesting, the actual standard deviation for the bond index, which is City World Big, is 9.85, and the performance is substantially lower than us, and even the benchmark for the equity portion, MSCI Developed World, standard deviation is over 11%, and once again, the performance is only 3.38%. Now, let's take a look at another portfolio just so you have a comparison. And this is one of our income portfolios, and this is one of the newest portfolios that we have. These ones are, there's two of them, and they have a track record of 5 years. Once again, standard deviation, the blue one is only 5.8%, and the performance is 8.69. I would also like to point out that these numbers are before any fees being deducted for the HON portfolios, the benchmarks as well, and the indices. So now, just one last comment that I want to make. We don't have to be the only solution. So it's not all or none with us. We can be a complement to your existing strategy. If you like some specific portfolio managers that you have been using, feel free to use them. We can be a core. We can even be a satellite. If you're on the IROC channel and you're comfortable selecting securities in the domestic markets, maybe North America, use us as a global solution and essentially let us take care of all the research. You concentrate on the markets that you know, and we can actually help you with the markets that you're not familiar with. So once again, it doesn't have to be all or none. It's a very good complement to your business. If you want more information, please visit our website. We do have an advisor site as well, a lot more detailed, specific, and I would even say technical information on our portfolios. You can contact us via email, and either Aaron or Dan can set you up on the advisor site. I encourage you to go in and just snoop around and look at some of the videos that we have and so forth. Obviously, myself, Robin, Chris Patterson, who's also one of the business development managers, is available at any time. We welcome the opportunity to meet to discuss how we can actually we can work together and help you with your business development and financial planning needs. Now, that's basically it. If you do have any questions, please ask him in the box. And we do have one question. So let's just quickly read this question.
Yes, thank you. We do have a question, and the question is, can you explain whether you prefer to use hedged ETFs versus non-hedged, and what are the costs of using ETFs that hedge the currency exposure? At HON, we do occasionally use currency-hedged ETFs. Currency management is one of the active decisions we make in our portfolios, and there are a variety of ways of doing that, and currency-hedged ETFs are one of the strategies we use. Essentially, what a currency-hedged ETF does is it still invests in the underlying index. An example would be the EFI index. If I want to invest in the EFI index without currency hedging, I would just buy the straight EFI index ETF. But there's also a version available which adds to that portfolio or basket of securities a forward contract. And the purpose of that forward contract is to X out the currency exposure. So if I like the EFI index from an investment standpoint and I want exposure to the equities there, I don't necessarily have to have exposure to the currency of that region. I can remove the currency exposure and just have the equity exposure. The cost of doing that varies, of course, depending on the markets we're talking about, but typically the ETF that has the currency forward in it will be approximately 10 or 15 basis points more expensive in its internal MER than one that is unhedged.
Okay, the next question is there any question of having CRA dispute the deductibility of RSP fees when they are combined with the non-registered fees? We've been doing this for a long time, and there's actually nothing from the CRA at this stage, so we're going to continue doing it until we get something final from the CRA disputing this fact. But like I said, we've been doing this for a long time, and I know that other portfolio managers are doing the same as well. So next question.
What are the custody fees and other charges? What is the MER on a $1 million or $2 million portfolio? There are no custody fees per se on a HON separately managed account. We do offer services through two primary custodians. There are trading or transaction costs associated with the portfolio. These vary by client and by the portfolio size, but typically range in the range of 15 to 25 basis points per annum. So what you're looking at in total fees would be your HON investment management fee, the advisor overlays their own financial planning or investment advisory fee, and then you have the transaction costs of, let's say, approximately 20 or 25 basis points on a small portfolio, and there are no other fees or charges. There are no specific custody fees.
Now also the question asked, what is the MER on a 1 million and 2 million account? So for $1 million, you're looking at about 0.74 from us. The trading costs accumulate up to about 0.6 based on our historical numbers. So trading and the management fee is 0.8, and then whatever the advisor adds to that. So if the advisor adds 1%, you look at 1.8. For 2 million, that's going to go with all the trading costs to about 1.7, all in. So next question is, okay, so HON is 0.8 plus about 0.4 for the ETFs plus 100 beeps to the advisor plus HST and everything. How is that comparing to the 2.2 in the case study? Am I missing something? No, you're correct. I mean, the fee to HON starts at 0.8. Now, for the ETFs, all our ETF fees are included in our performance numbers already. And yes, the fee is it could be 1% to the advisor. It could be less, or it could be more, plus the HST. So I gave an example of 2.2 in the case study for the average. Depending on the amount of money that you client, for $1 million, you're looking at about all in, and that's including the ETF. The average ETF fee is not 0.4 for us. We did a number of studies. The average on our portfolios ranges from anywhere 0.23 to 0.26, taking everything into consideration, including the MERs of the ETF, assuming that the advisor charges 1% for $1 million client, including trading costs, the all-in fee will be about 2.03, 2.06%. So it is slightly lower than 2.2% average. Now, next question. Will a copy of the slide presentation be available? Yes, please. We can send we can send a presentation to anybody requested, so feel free to send us a quick email.
I'll take the next one. Do you have lower fees for high net worth? Does the $1 million client pay 80 basis points also? We offer a tiered investment management fee schedule by household. It starts at 0.8% on the first $500,000 and quickly reduces from there. And it is calculated on aggregate household assets. So usually when we bring a family in, they have multiple accounts, including several RSPs, non-registered accounts, children's accounts as well. And we bundle that together for fee billing purposes. And it does go down. And the advisor, of course, can offer discounts on their fees as well as the portfolio grows in size.
Okay, the next question is, please confirm the HON fee of 0.8 is on top of the ETF MER. Yes, that is a fact. We do use ETFs, and they have an MER built in, and we charge 0.8 for the management fee. Obviously on the high end, that's for a $100,000 account. Once the assets under management increase, the fee is tiered down. Now, once again, the average, and we do have this research and analysis, the average in our portfolios for the ETF fee is about 0.23 to 0.26. And once again, all the performance numbers that are available on our fact sheets and on our website include or have the MER already built in or deducted.
And I'll add to that, Christian. The good news for investors is that MERs on ETFs are quickly coming down. There is significant competition in the industry among different manufacturers, that particularly on the core beta holdings, which provide broad exposure to major indices. So the internal MER on the majority of our traditional asset classes is very low. Where we are willing to pay up and pay a slightly higher MER would be on a thematic or opportunity exchange traded fund that really is offering something very special to the portfolio, a diversification opportunity, something that's very has low correlation or outstanding return potential. And in that case, that particular ETF might have a slightly higher MER, but well worth it for what it is doing for the portfolio.
Now, the next question is, how can we see the current portfolios before offering them to the clients? We do have fact sheets available on our website for all the 11 portfolios. It gives you a breakdown of all the key information of that portfolio, the tactical ranges, and so forth. We can also give you the holdings of that portfolio from the last quarter as well. So if you're interested in seeing the actual ETFs that we have utilized from last quarter, we will be more than happy to send that information to you as well. Please send us a quick email and request that information. Now, it looks like that's the last question. So thank you once again for joining us today. We do appreciate your time. If you do want more information, feel free to give us a call at any time or visit us on our website, once again at honinvest.com. And once again, we'll be more than happy to give you access to our advisor site where you have more information. One more thing from Robin, please go ahead.
Yes, we wanted to mention that HON is having an advisor event on April 18th at the Glen Abbey Golf Course. And we do still have some limited space available. If any of you are interested in joining us and you're in the Toronto GTA area, it's in Oakville, Ontario, please contact our inside sales department and we would be happy to have you join us April 18th, and it is in the afternoon, 12 to 3:15.
Once again, thank you. Have a great day, everyone.